Hello everyone, welcome to this video of how to value a stock using intrinsic valuation method. In the previous video, that is part 1 of the video, we spoke about the concept of intrinsic valuation and the various factors involved that are used for determining the intrinsic value of a stock. In this video, we are going to talk about this concept of intrinsic value in further detail. So let's get started. In this video, that is part 2 of the video, I'll be talking about the top 5 pointers that I've listed down in this slide. That is brief introduction of intrinsic valuation, why valuing an asset using conventional method can be misleading, what are the different types of financial statements, what are the few key terms that are involved for determining intrinsic value, and then what are the two key approaches for determining intrinsic valuation. And the part 3 of the video will have inputs required for calculating intrinsic value of a stock, explaining inputs which are required for calculating intrinsic value, and then finally in the end we'll be calculating the intrinsic value of a stock. Now, intrinsic value of an asset is basically defined as the present value of future free cash flows discounted with an appropriate rate. Now, this method of calculating a stock's intrinsic value was first described by an American economist named John Burr Williams in 1930 in his book called The Theory of Investment Value. And a very important fact for intrinsic valuation method is that it is best suited for valuing companies which have consistent free cash flows. And hence we have seen that companies which are, like FM companies which are usually operate in FMCG sector like Nestle or, HUL or Britannia, these companies usually trade at a very higher multiple as compared to other companies because they have a history of consistent free cash flows, and hence market awards them, or markets usually give them a higher multiple as compared to other companies. And and similarly, companies which have fluctuating free cash flows, or maybe negative free cash flows, are usually given a lower P multiple by the markets. And again, another key factor for determining the value using intrinsic valuation is that if we try to do a value analysis of a stock just by considering the net earnings, or EPS, that is earnings per share, or maybe profit after tax. So basically all are the same thing only. So whenever we do a valuation done by net earnings may not reveal the true picture because these can be adjusted. So when I say adjusted, it can be either inflated or deflated depending upon the accounting practices followed in an organization. So let me try to explain this with the help of an example, that why valuing a company based on net earnings or profit, or EPS for that matter, can be misleading. So imagine a hypothetical company named ABC, which operates in a particular capital incentive intensive sector. Say, for example, it is operates in a steel sector, and the company recently has reported an annual profit of, let's say, 1,000 crores. But for reporting that, or for doing so, the company had to invest 700 crores in its plants and machineries for expansion and maintenance purpose. And this is very common in all the capital intensive industries, because if they defer the expansion, or if they defer the capital expenditure, then they might do it for 1 or 2 years, but then while doing so, they may have issues related to quality, or maybe they cannot survive in the market, because that is how competitive this capital intensive sector is. So they have to have this they have to make this sort of capex to ensure their sustenance in the market. And hence what we have seen is that although as per the income statement, the company has reported company had reported a profit of 1,000 crores, but then the net cash inflows for that company is definitely much lesser than 1,000 crores. And we'll see what exactly how much would the free cash flow for that company would be. But then definitely it is lesser than 1,000 crores, because to get that 1,000 crore, the company is spending 700 crores for in this example, right? And this is the problem with these capital intensive industries. And if I try to do a valuation using a EPS or a net profit, then definitely that will not give me the right picture. Second point is companies which have fluctuating free cash flows. Companies which have fluctuating free cash flows, or even negative free cash flows, are thereby valued lower in the market, and vice versa. And this is what exactly we have discussed. And hence the business which are cyclical in nature, like steel, auto, or all other commodity sector basically, so they usually trade at a lower P ratios because of their fluctuating free cash flow. So market likes certainty, and market detest the uncertainty, and because of this uncertainty in their free cash flows, the markets usually they do not view these sectors, these cyclical sectors, in a positive way, right? Now, before we get into how do we calculate free cash flows and all the other stuff, first let us talk about the different types of financial statements that we get, and why we are focusing on this is because while calculating free cash flow, there is a term called the cash flow from operations. So basically, I have written it down in the at the bottom of the screen that free cash flow is usually how we determine is that we take this cash flow from operations and we subtract the capital expenditure from cash flow from operations, right? So to determine the free cash flow, we should know exactly that where should we get the inputs required for calculating free cash flow, and this is how the different types of financial statements look like. So first we have balance sheet, which basically talks about how the assets of a company are formed, how the assets of a company are funded, and basically talks about the assets, liabilities, and shareholders equity. So in the previous video of our relative valuation, we have spoken about these things in detail, so you may refer that video for further discussion. And similarly for profit and loss statement, we have so I have written down some key terms, not all, because that is not the course that is not the main discussion for this video. Our main topic of discussion for this video is the last one, which I have highlighted in brown color. So basically, a cash flow statement is typically divided into three parts, which is cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. And from cash flow from investing activities, if we further drill down this cash flow from investing activities, we'll get the capex, that is the capital expenditure that a company is doing for ensuring its sustenance in the business. And then sometimes the company do acquisitions as well, right? So if they are into inorganic growth of something, then they may acquire some companies for ensuring their market share in the market, for ensuring the better market share. And then there are companies which do divestments as well. So if they perceive a division which is non-core to its main line of business, then they may try to sell off that company and get rid of it. So a cash flow statement depicts a true picture of how much cash is coming in, going out of the business. So basically it tells us that how much cash is coming from operations and how much cash is going out of investing activities and financing activities. And these are less prone to the accounting shenanigans that we get to see. So basically in the previous slide, that is what we were discussing about, right? That if we try to value a stock using net earnings or EPS, because each of the terms involved in calculating EPS might be adjusted as per the accounting norm, so they are more prone to these so-called financial shenanigans. But then when we try to analyze it from a cash flow statement point of view, then we are we get the exact business reality, that how much of cash is coming into the business and how much of cash is going out of the business. And as I mentioned before, that free cash flow of a company is defined as cash flow from operations, which basically we get from the cash flow statement, and then we minus the capital expenditure, or we subtract the capital expenditure from the cash flow from operations. Now, the few terms that are involved in intrinsic valuation can again be, divided in looking at how we are trying to value a company. So there are two perspectives of valuation here. One is the equity valuation and one is the enterprise valuation, or an EV. So in equity valuation, what we do is we try to directly calculate the equity value of, or we try to directly calculate the uh, 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 stock value of a particular company. And in enterprise valuation, we value the entire business, and then we subtract the debt part of it and or other obligations the company might have. So when we are doing equity valuation, though, there are few terms that are involved. That is free cash flow to equity, cash cost of equity, equity risk premium, and stocks beta. And what do these terms mean? We'll see in the subsequent slides. And similarly for enterprise valuation, we have free cash flow to firm, and then we have something called weighted average cost of capital, or also known as WACC in business parlance. So we'll be talking about each of the terms in detail. So as I mentioned, that free cash flow is nothing but the amount of cash that can be taken out of the business without affecting its operations. And hence there are two types of free cash flow, depending upon if we are whether we are valuing the equity part of a business or we are valuing the entire business. So if we are valuing the equity part of business, then we have something called free cash flow to equity. And if we are valuing the entire business as a whole, then we have free cash flow to firm. So if we talk about free cash flow to equity, it is basically it gives a measure of potential dividend for the shareholders. Means that uh, what how much money is available for the company which it can distribute to its shareholders as part of dividend, right? And basically it is calculated as net income plus depreciation and amortization minus capital expenditure minus change in working capital plus new debt issued minus principal repaid. So this may look a bit complex, but then what basically we are doing is we are trying to rationalize the net income, because as we have seen that if we just try to value a company based on net income, that may not reveal the true picture of a company. So what we have to do is we have to adjust this net income to ensure that all the cash flows which are coming into inside the company, which are going out of the company, these are all adjusted, and we are looking from a shareholders point of view. Hence that is being termed as FCFE, or free cash flow to equity. So what basically we are doing is we are adjusting this net income for all the non-cash expenses. So when I say non-cash expenses, it means depreciation or depreciation and amortization are basically the accounting expenses but not the real expenses. And capital expenditure and change in working capital is something which are the real expenses, but then they're not accounted into the financial statement. So we need to adjust all these things to arrive at a key figure, which is free cash flow to equity. And basically this free cash flow to equity determines that how much money after reinvesting back into the business can be given to shareholders as part of dividend, right? So hence we have written that it is a measure of potential dividend for the shareholders. And Warren Buffett, what he uses is he discards the capital what the business gets by issuing debt, and after discarding it, what he uses is called owner's earnings. So basically in the above formula, if I just remove the cash inflows due to debt issues, so we will arrive at owner's earnings, which Warren Buffett usually he takes that into consideration while valuing a particular company. If I come to free cash flow to firm, so basically this is the cash flow to which the creditors and equity investors are entitled to. So if we so basic difference between FCFE and FCFF is that FCFE belongs to what the equity investors are entitled to, and FCFF is what all the so the people who are giving capital to the company. So basically there are two categories. One is the creditors. So these usually they are the banks, or so people who have purchased bonds of the company. So they are the creditors. They are not the shareholders of a company. And then there is second category called equity investors or shareholders who are a part of the company. So whatever profit, if a company is profitable, so whatever profit a company reports, the shareholders are entitled to it. And how do we calculate FCFF? Is we take the after tax operating income. So we take the after tax EBIT, and again we adjust in a similar fashion the way we did for FCFE. We add back the depreciation and amortization because these are the accounting expenses, not the real expenses. And then we subtract the capital expenditure because these are the real expenses. And again the change in working capital. So basically what we can see here is that the capital expenditure and the change in working capital are basically the reinvestments that a business is doing. And we can also term this capital expenditure as a long-term investment and the change in working capital as a short-term investment, right? The other terms which we have also discussed in our previous video, so we'll quickly go through each of the terms. So basically the discount rate is depicts the risk in the company's free cash flows, and again higher the uncertainty or risk in free cash flow, higher will be the discount rate and lesser will be the assets intrinsic value and vice versa. So if I foresee a higher risk in a particular company's cash flow, so I should be having a higher or I should be having a higher rate discount rate while doing intrinsic valuation calculation. And if I see company with relative stability, then I'll be assigning it a lower discount rate, and hence its intrinsic value would be higher. Terminal value is again we have discussed in the previous video that it is basically the estimated value of a company beyond the explicit forecast period. So usually what we do in typical FCF is typical DCF method is we try to project the free cash flows of a company till a certain period, let's say for 5 to 10 years, and then after that we put a full stop to those free cash flows, and then we arrive at a terminal value which would reflect the value of that company as a going concern, right? So again there are two methods. Either we can liquidate the entire company after the 10th year, like we saw in our previous in the part one of this video, wherein the company was sold off after 10th year. So there are two ways. One is either you can liquidate the company, or as a if the company goes as a continues as a going concern, then we have a different way of calculating the terminal value of that particular company. And coming to enterprise value, so enterprise value is also called as firm valuation or firm value. So basically, it is the summation of market value of shareholders' equity and debt minus the cash and the non-operable assets. And then how do we calculate the intrinsic value of a company is basically the discounting free cash flows with the respective risk adjusted rates, and doing adding a terminal value at the nth year. And then we also add back the cash and cash equivalents, and subtract the debt obligations or debt liabilities if a company has. Right. Now, in addition to the terms that we spoke about, we also have few of the key terms that are, also very much important from intrinsic valuation method. So the first term is called the risk-free rate, and as the name suggests, that these are basically the yield on the 10-year or 30-year government securities, which are basically the bonds, and considered as risk-free investment because the bonds are issued by the government, and the basic presumption is that the governments don't default. So these are the risk-free rate which have considered while doing an intrinsic valuation calculation. Now, equity risk premium is something that the premium that an investor demands for investing in equities instead of risk-free investment. Like, so if an investor wants to invest in equities, so he expects some premium because there is a risk involved when investing in equities, that his that the desired cash flows taken into calculation may or may not arrive in the future. So there's a risk involved in that, and hence for compensating that risk, that is the minimum bare minimum that the equity investor is demanding. Coming to third point, that is called a beta. So beta is basically it tells us about the volatility of a stock, and it is estimated by looking at how much a stock has moved in the past relative to the market. So basically, if a beta value is greater than 1, let's say if a beta value is 1.31, so it means that it is more volatile. It is 31% more volatile than the underlying market. And if a beta value is less than 1, let's say 0.79, it means that it is less volatile than the than the entire market. So there's a model called capital asset pricing model, also called as CAPM, which is very much used in modern portfolio theory. So as per the CAPM, cost of equity is defined as the risk-free rate plus beta into equity risk premium. So basically, what it tells us that the cost of equity is nothing but the cost that so if an investor or an owner is looking for returns, so he should have that returns on that equity part, which has to be greater than the cost of equity. So cost of equity is basically the cost which it is the cost of capital basically for that particular investor, and the return on that equity should be at least greater than or should be at least equal to cost of equity for getting returns in future. So cost of equity is determined as risk-free rate plus beta into equity risk premium. And hence weighted average cost of capital is basically the overall cost of capital of a firm, which is offset by its weightage in the capital structure, that is debt and equity. So how do we calculate WACC or WACC is that let's say so we'll talk about how to calculate WACC in the next slide. Formula is that you offset each of the values with the respective you offset each of the cost of equity and cost of debt with the respective contribution to the entire capital structure. So let's take a look at how do we determine the WACC of a company. So let's say that there's a company called ABC which have certain parameters, like, so assume that its current market cap is, let's say, 57,000 crores, and it has a debt of 5,300 crores on its books. And let's consider that the current risk-free rate is 7%. So this 7% could be the present yield on the 10-year government securities. And let's assume that the stock is a bit of a volatile in nature. Hence, we have taken 1.25 as its beta value. And let's assume that equity risk premium, or the premium that the investor is looking for investing in stocks, is 6%. So cost of equity in this case would be, as per the formula, it would be risk-free rate plus beta into equity risk premium, and cost of equity is somewhere around 14.5%. So this is how we arrive at the cost of equity. Now to arrive at the cost of debt, we need to calculate something called interest coverage ratio. So basically what it tells is how much of my interest expenses is being covered by my operating income. And so again, this metric should always be higher the better. So if I have interest coverage ratio of let's say 25 in this case, so what lenders do is so higher this metric. So what lenders or the creditors do is they assign some percentage to the risk-free rate, and that is called a default spread. So since in this case the company looks to be having a consistent free cash flows because of the higher interest coverage ratio, so the default spread would be on the lower side, that the creditors are not much concerned about its sustenance of the free cash flows. And had it been on the other side, like if this value is let's say the interest coverage ratio, the value comes out at let's say 2 or 3, then creditors would be having a they may not be having much of confidence in companies' free cash flows, and hence they would be to offset that risk, they may be demanding a higher default spread, and in that case the cost of debt would be higher. But in this case it looks to be on the lower side. And let's assume that the company is currently having is operating in the tax rate of of 40%. So the cost of debt can be determined as the formula which I have mentioned in the slide, which is risk-free rate plus default spread multiplied by 1 minus marginal tax rate, which in this case the cost of debt would be around 5.4%. So to arrive at the weighted average cost of capital, what we have done is we have taken the contribution of equity and debt to the capital structure. So equity is basically the 57,000 crores that we just spoke about, and then debt is around 5,300 crores. So what we have done is we have tried to offset the cost of equity with its respective contribution to the with respective contribution to the capital structure. So 14.5% is multiplied by 57,000 divided by the total capital employed in the business. And similarly for cost of debt, we have multiplied 5.4 with its contribution to the total structure, which is again 5,300, and again divided by the total capital employed. And in this way, we have arrived at the weighted average cost of capital to be 13.72. So what exactly is the significance of this WACC is that the owner should at least be getting returns on the capital invested, or ROCE, what we call it, to the tune of more than 13.72. And if he is not getting the return on capital employed greater than the cost of capital, then it does not make any sense for that business to grow its cash flows. So it is imperative that the return on invested capital or return on capital employed should be greater than this value of weighted average cost of capital. Then only that excess return, that delta, is going to matter to the shareholders in the long run, right? So as I mentioned in my earlier slides as well, that there are basically two methods of valuing any stock for that matter. So basically there are from we can either value it from a firm perspective, that is enterprise value, or we can directly value it from a equity perspective, that is called equity valuation. So when we try to do it from a firm perspective, that is in that case we take free cash flows to firm, and when we try to value it from an equity perspective, then we have free cash flow to equity. So what we do in case of FCFF, we discount the operating cash flows by weighted average cost of capital. Why? Because it takes both debt and equity into picture. And if we are just focusing on the equity part, then we are just discounting the owner's earnings, which is basically free cash flow divided by the cost of equity. And as we have seen that the first one results in enterprise valuation, and then to arrive at equity valuation, we subtract the debt liabilities, or if any company has any sort of obligations like healthcare obligations or any underfunded pension and all. So that also those so entire so whether it is debt obligation or it is obligation of some other nature, we need to remove all those obligations to arrive at a fair value of equity. And for the second one, that is FCFE, we directly get the equity valuation of a particular company, and that divided by the total number of shares outstanding will help us in arriving at the value per share. So when it is done correctly, so when I say when done correctly means when all the inputs are plugged properly, then in that case both equity valuation and enterprise valuation yield similar results for a particular stock. So to conclude this video, intrinsic valuation is best suited for companies which have consistent free cash flows, and companies with consistent free cash flows usually trade at a premium. So we have already spoken about, because market does not like uncertainty at all. They and companies which have a certain which have consistent free cash flows, markets usually give them a higher P multiple or a higher price to book ratio. And same thing, that if companies are operating in a cyclical sectors, or if the companies are in financial services, so usually we do not consider even financial services for valuation using intrinsic valuation, because financial services, the entire business model is very different, that they take capital from that they raise capital and then they provide capital in the form of loans. So the intrinsic valuation method is not best suited for calculating fair values for financial services companies. And all the companies with consistent cash flows can be valued either by equity valuation or enterprise valuation. We have already discussed about that. And free cash flow, or the owner's earnings, is the true measure of a company's ability to generate cash and generate value, and not the profit. And we also seen that how profit can be misleading in most of the cases. And in the last, I think very important point which we can take from this slide is that price to free cash flow metric is usually, now since price to earnings or price to book is a metric which can be fairly adjusted and manipulated. So usually what analysts, equity research analysts are trying to do is they try to capture the price to free cash flow metric for a particular company, and then compare it with peers. And if they find it that if they find this a number to be on a relative side, then this can be considered as a better better candidate for a value investing. So guys, this was for intrinsic valuation method for part 2, and part 3 will be covering about the further details, and we'll also see how do we calculate the intrinsic value of a stock with an example that we'll be going to do it, right? So if you have any doubts regarding to this video, anything which you have not understood, do let me know in the comment section. I'll be very happy to help you out, guys, right? Okay, thank you and have a nice day.